Okay, ITC, by the way, is at a fresh 52-week high. So amidst all this volatility, ITC is kind of the oasis, in the desert. Now at a fresh 52-week high, post its numbers. But JK Tyres posted a decent set of Q3 earnings. Revenue saw an 18% rise. Margins expanded marginally on account of softening commodity costs, cost controls, as well as price hikes. Anuj Kathuria, the president, India at JK Tyres, joins us on the show to talk more about that. Anuj, good morning and thanks for joining in. I was going through the conference call highlights, and within that you mentioned that the volume growth in Q3 was around 10% compared to what you saw same time last year. Can you tell us how is the demand situation now? Do you think this double-digit volume growth is something that can continue towards the end of the fiscal? And what is the expectation for FY24?
Yeah, good morning, Sonia. So as we saw that the Q3, we reported a good growth. The revenue growth over the corresponding quarter was around 17%, and the EBITDA margins were also up to 9.6%. So that is the good news. The demand is holding up. In fact, we expect that in the current quarter, that is Q4, which is generally a good quarter. So further demand should be, should be good, should be robust, and both in the OE segment as well as in the replacement market. In the OE, the growth has been much better. Replacement market also, the demand is robust, and going forward, we expect that this will hold on.
Can you give us some numbers? There was a 10% volume growth in Q3. Do you think you can do the same in Q4? And for FY24, what is the outlook in terms of volume growth?
See, in terms of what you're asking for is in terms of volume, we have also seen that, owing to the increase in the commodity cost, the prices have also been going up. So definitely it's a combination. The top line growth is coming out of both volume growth as well as the increase in the price. So we expect that the volume growth for Q4 should be even better than what we saw in Q3.
Okay. All right. Hi, Anuj. Good morning. The other heartening aspect is margins. They have improved a little bit and they're on their way to double digits. So do you believe there is more scope for margins to improve from here on? And also, so I want a number out there, you could give us a band. And also, how's your balance sheet looking? Any debt reduction targets for FY24?
Yeah, so, as far as margins are concerned, the EBITDA numbers are inching up. We had reported 9.6%, which is almost looking at the double digit. Q4, as I mentioned earlier, is expected to be a better quarter. So we expect that the EBITDA margins to inch up further. How much would depend on three factors. What is the volume growth that we see? Also, while there is a softening of the commodity costs, but again, how much of that will be experienced in Q4? Because certain things come with a lag effect. And finally, the market forces will decide what is the kind of the pricing. So a combination of all these three we expect that the EBITDA margin should be inching up further.
And on debt?
On debt, yeah, we are working steadily to reduce our debt. We have been able to make certain good repayments on the long-term borrowings, but we are also trying to see that how we can, make the working capital even smarter. Over a longer period, we intend to reduce up to almost 35%, maybe in the next couple of years, and that would help us de-leverage our balance sheet to a great extent.
Okay, you also mentioned that EBITDA margins will inch up further going forward. In the conference call, you said that you have hiked prices by 3% so far to offset higher RM prices. Any more price hikes that you have planned? If yes, what would the quantum be like?
As you know that, the pricing is a function of the market forces. So it all depends on how the demand plays out in the months of February and March. January was a month where, the number of working days in certain regions are lower because of the festivities. And also, northern region experienced a very harsh winter. So, but I think so February and March should be much better, both from the OE side and the replacement side. So let's wait and watch, keeping our fingers crossed.
Okay. You've also developed a new range of electric vehicle-specific smart radial tires across categories, right? Trucks, buses, LCVs, and now we're seeing EVs pick up in a big way. Will that help you operationally? I mean, are these tires that you developed for EVs higher than your regular margins? And will that help increase your blended margin picture?
So we are working on tires which are specifically meant for EVs, whether it is in the truck and bus space or even in the passenger car. Last week we launched the Ranger HPE, which is meant for the passenger car. It is a high performance tire which is specifically meant for the electric vehicles. These tires have a lower coefficient of rolling resistance. They also have much lower noise levels and comply to all the parameters. We will be able to position these products into the market very competitively, and definitely with the these are all premium segment tires, so they will be having better margins as compared to some of the other tires. Also in the truck and bus, we are working on both tires which are specifically meant for electric vehicles. We have already started supplying to the major OEMs, especially for the buses that run in Delhi. Those have our tires, the EV buses. We are also working for, other than the EV buses, we are working with the OEMs to ensure that we deliver them tires which are making the vehicles more fuel efficient. There are regulatory norms that are upcoming which will mandate that the vehicles are having better fuel efficiency. So we are working on both.
Okay, all right. Anuj, just to clarify on the debt aspect, currently what is the debt in the books? Overall debt, 5,000 crores?
Yeah, a little lower than that.
And in the next couple of years, so by 2025, you're saying it'll come down by 35%. So it should be south of 3,500 crores by 2025? Realistic?
That is what we are working towards.
Okay. All right. So by 2025, the debt number will come down by around 35%. We have got that. And also, the Mexico business, that's a smaller part of the overall business, but margins out there are still struggling. Have things bottomed out there and margins will improve even in that business?
Both our subsidiaries, whether it is Cavendish or Tornel, they are doing quite well. In fact, the margins both in both the businesses, at least in the Q3, were robust. And we expect that while there are challenges in the international market, but we'll have to see how we kind of navigate through these times. But as of now, we are holding up.
Okay, as of now you're holding up. Just one more question, a slightly broader term question. The tire industry is going up the technology curve in different ways, right? Whether it's related to electric vehicle technology, as we just discussed, or even enabling of the labeling norms, like, which the government has put forward. So all of that put together, what do you think happens to the overall capacity of the fixed assets? I mean, will you have to sort of scale up your capacity in the new EV-related tires? Will there be a separate cost going forward?
We have been, utilizing our capacities very well. They are in the range of 90%. Going forward, we had announced last year capacity expansion programs. The total Capex outlay for that was 1,100 crores, out of which 300 crores, which was meant for the the debottlenecking and the extraction, has already been implemented, and we are able to realize the additional output from there. Two other programs, one for the PCR segment and the other for the truck and bus radial, that is also being done right now. And we expect that the enhanced capacity output from these expansion programs should be coming through in the second half of the coming financial year. So these capacities are being set up with keeping in mind the future requirements of the products, whether they are for electric vehicles or they are for the premium segment in the passenger car. So those things are built into our programs.
All right, Mr. Kathuria, thank you very much for your time. It's a pleasure. And, it's not often that we have you on the air, and I hope you're back on more often. Thanks very much for joining us with that conversation. Well, we'll take a quick break here, but before that, look at the market, which is down 110 points. And as we were highlighting, I mean, like Friday, there is very clear weakness in the broader markets. 1,200 stocks now lower and about 850 stocks are higher. You just have to look at what is selling off, and it's a long list of volume-led losses which are coming through. Adani Enterprises and Ambuja are the two biggest volume-led losers right now. 5.5% lower on Adani, and Ambuja is down 3%. MCX is down 5%, 5.5%. Manappuram is down about 3.5% in reaction to numbers. LIC Housing is down 4% or so. And there are so many of these 3.5% losers that it's a long list out there with what's going on. Indus Tower with a 12.5% pop is the biggest gainer. But Paytm is the biggest volume-led gainer with a 5% pop. Now, it's come off the highs of the day. M&M Finance is doing very well as well on the back of third quarter earnings. And we speak with the management in a bit. We take a break here. We have the management of Star Health Insurance